In this week's market update, trade tensions trigger a flight to safety, China retaliates by letting the renminbi depreciate, and UK political uncertainty hits the pound. Volatility is back on investors' radars this week after an unexpected escalation of trade tensions raised the risk of economic slowdown and currency wars. The US stock market suffered its worst one-day fall of the year on Monday, with the S&P 500 down 3% and the tech-heavy Nasdaq off 3.5%. Other markets around the world tumbled as well as investors piled into safe havens such as government bonds and gold. The VIX volatility measure, Wall Street's fear gauge, rose above 23 for the first time since May's mini retreat. Markets had already wobbled in the middle of last week after the Federal Reserve failed to convince on future interest rate cuts. Although the US cut interest rates by a quarter point last Wednesday, Fed Chair Jay Powell was less clear on the future trajectory of rates than the market had hoped. That set a nervous tone to markets, so when the next day Donald Trump announced further sanctions on $300 billion worth of Chinese exports to the US, investors were in no mood to give him the benefit of the doubt. When China retaliated by letting its currency fall beneath a key psychological level at the weekend, the stage was set for a bloody Monday in the markets. The latest round of tariffs is worrying for two reasons. First, it now brings effectively all China's exports into the net, and that means that the president may start looking elsewhere, such as Europe's key auto market. Second, it extends the reach of the Chinese tariffs to a wide range of consumer goods, which had previously been excluded from imports taxes. With end consumption being such a big driver of the US economy, it may be only a matter of time before the latest round of tariffs starts to undermine the so far relatively buoyant American economic picture. On Friday, we saw job creation fall back to 164,000 jobs from over 200,000 in June. Still strong, but heading the wrong way. The MSCI All-World Index fell 3.2% last week. That was the worst weekly fall since the market gyrations at the end of 2018, when trade tensions and the Fed last combined to spook investors. The list of things to worry the markets lengthened on Monday morning after the Chinese currency fell below 7 to the dollar in an apparently deliberate move by Beijing to use devaluation to ease the pressure on its exporters. Donald Trump certainly thinks so. He tweeted that China is manipulating its currency, a serious allegation that ramps up tension between the two countries. A cheaper currency makes exports more competitive, so the foreign exchanges tend to be weaponized as trade tensions deepen. The fact that China has for many years viewed 7 renminbi to the dollar as a red line suggests that this is no accident that this level has now been breached. Beijing is sending a clear message to Washington about its willingness to dig in and fight back over trade. Stock markets reacted badly to this cocktail of trade and currency news. In Asia, mainland Chinese stocks fell by 1.9% on Monday, while Hong Kong, which has other worries, of course, was 2.9% lower. Japanese shares were 1.8% weaker, and South Korea, another trade-dependent economy, fell 2.6%. That was Monday. On Tuesday, most Asian markets have fallen a bit further in response to the US's continued weakness. Unsurprisingly, the bad news spilled over into European trading on Monday. Germany closed 1.8% lower, the UK market was off 2.5%, and France down 2.2%. As investors fled riskier shares, they naturally moved into perceived safer havens. These include government bonds, where demand pushed prices higher and yields lower. They move in the opposite direction, of course. The yield on 10-year treasuries in the US fell to 1.76%. That's well down on the 3.3% it reached last year, when the expectation remained that the Federal Reserve would continue its 4-year interest rate tightening cycle. That prospect has now evaporated, with markets pointing to another 100 basis points, that's 1 percentage point reduction in US rates by the end of next year. Traders now expect the main US interest rate to be between 1 and 1.25% by the time of the US presidential election in November 2020. That will please President Trump, who's been calling for lower rates for some time. He knows that a healthy economy and high stock market is the best recipe for re-election, and he's put pressure on Jay Powell at the Fed to help deliver those through cheaper money. Lower interest rates also provide cover for the president to wave the trade stick at China and in due course probably Europe too. It's probably no coincidence that the latest escalation of the tariff battle happened within 24 hours of last week's rate cut. Investors clearly think that heightened trade tensions will indeed bump the Fed into lowering rates further sooner rather than later. The odds on a September cut have risen from 60% to 95% since last week. The president is probably also calculating that with an election looming within 18 months, if he's to play hardball with China, he needs to do it now so that he can engineer better news flow in the run-up to the vote. On this side of the Atlantic, gilt yields have also fallen to historic lows. The 10-year gilt yield is now under 0.5%. As in the US, this indicates that the next move in interest rates will probably be down, although the Bank of England continues to sit on its hands for now. The reason for that is not hard to understand. The election of Boris Johnson as leader of the Conservative Party, and so as Prime Minister, has raised the prospect of a no-deal Brexit in October, and the bank knows that it cannot risk slowing the economy in those circumstances. This week, retail sales figures for July were the weakest on record for that summer month. The value of sales was just 0.3% higher than a year ago, despite good weather, and that was the worst rise since records began in 1995. The problems facing the UK economy have been illustrated most clearly by the performance of the pound, which has fallen to just about its lowest level since the EU referendum undermined sterling in 2016. At $1.21, the pound has not been this weak against the dollar since it briefly approached parity in 1985. The other reason investors are nervous about UK-denominated assets is the apparent abandonment of the last 9 years' austerity politics by the Johnson government. It's hanging by a thread with a majority, even including the votes of 10 DUP MPs, of just one. The new Prime Minister, with an eye on the timing of the next general election, has launched a spending spree to ease the impact of Brexit in a strategy that's being called boosterism. The fact that investors are worried about excessive issuance of government debt to pay for that spending is shown by the differing performance of shorter and longer term gilts. Bonds due for repayment many years hence are more closely linked to worries about oversupply than shorter term bonds, which are largely driven by interest rates. And the gap between 10-year and 30-year bonds now stands at its widest for 2 years. Now, investors are watching different bond yields closely on both sides of the Atlantic because the fixed income market continues to flash red warning lights about the likelihood of recession. The difference between the yield on 3-month Treasury bills and that on a 10-year bond is more negative than at any point since the financial crisis, and that signal has been triggered before every recession of the past 50 years. The commodity markets are also responding to the recent escalation of trade and political tensions. Oil slumped on the announcement of the Trump tariffs, falling by around $7 last week on a single day before recovering slightly. The fear for oil traders is that growing supply, particularly of US shale oil, will flood a market in which demand is flagging as economic activity slows. The escalation of trade tensions this week sent oil lower again, and Brent is now back below $60 a barrel, and it's heading for a technical bear market since its April peak. Meanwhile, and finally, gold is back in favour, living up to its reputation as a safe haven in troubled times. At around $1,470 an ounce, the precious metal has not been this pricey since 2013 at the height of the European sovereign debt crisis.